Hi, welcome. It's Mary Ellen McGonagle here with your weekly Edge show for January 20th, 2023. Let's get started, and I'll share with you what I am going to be reviewing today, and that is taking a look at the broader markets. Where did we close the week? Are we in an area of resistance, support, and what to be on the lookout for going into next week and beyond? Also, taking a look at some of the headline news that drove price action and also other activity that pushed some stocks quite a bit higher than others. Last up, viewer question of the week. And that question has everything to do with one of the areas I mentioned as far as the most impactful item that is taking place. And this is going to be outside of earnings reports. So I will go ahead and share that particular event. And then I have 4 stocks that have subsequently rallied in response. So let's go ahead and get started and take a look at some of those headline news that drove price action this week. First up, in the beginning, of course, we had that holiday shortened period, but retail sales for December came out and they did drop for the month, which was surprising. We did see a decline in retail stocks overall, certainly on those first 2 trading days, and some of that malaise in the consumer discretionary and in particular retail area did linger throughout the week. We also did get information relating to inflation, and that was wholesale pricing, and it did see a big drop, the largest since 2022. However, it was because of reduced gas and food prices. And the reason I'm pointing that out is because gas and food prices are the most volatile part of many of these inflation gauges, PPI, CPI, and so on, so that when you see the PPI drop, and it is solely due to gas and food prices, it's not going to be viewed quite as constructively. And that was the case this week, where the markets, we did not see a rally despite a drop in PPI. We also had several Federal Reserve officials speaking at various events, and the theme among their speeches was very similar in the sense that anticipation of keeping interest rates elevated throughout most, if not all, of this year. And then 2 of the Federal Reserve officials did cite that they anticipate the Fed funds rate to get over 5% this year. So that was a bit of a damper in the markets as well. Also, on Thursday, we did get a report that weekly jobless claims fell to a 4-month low. And this jobs report is something that the Federal Reserve is very closely watching because they want the job market to soften. In turn, that is expected to reduce spending among consumers and current employees, and then in turn, of course, ultimately to reduce inflation. So in other words, this jobless report did come in stronger than anticipated, so not great for the markets. However, we did see news today on earnings that was quite constructive. Let's take a look at next week, what is due out, and we are going to have that PCE, that's that personal consumption expenditures report, come out. This is the most closely watched inflation gauge by the Federal Reserve. It comes out later next week, so on alert for that. And then also we will receive January, both the manufacturing and the services PMI data, which is also inflation related as well. So let's go ahead from here and take a look at where exactly did we close the week with the markets. And here we are with the daily price chart of the S&P 500. It did close the week down about 0.8%. And a couple of items of note here, and that is, this is that decline that we spoke of that took place earlier in the week, certainly with that Wednesday pullback being the most dramatic. However, today on Friday, we did see a nice rally, all about, or certainly a lot of it having to do with Netflix coming out with higher subscribership than anticipated, which in turn helped buoy other areas of the market. So as it relates to the S&P, this red 50-day simple moving average. That's going to be highly relevant here. We want the index to at least regain, trade back above this 50-day. And then also that 3,900 level was widely viewed as an area of upside resistance. We closed the week at 3,972, so above that 3,900, which is constructive as well. On the momentum front, that RSI, it had dipped into negative territory, but good news, it closed back up above that 50, which is positive. And then the stochastics, a faster moving momentum indicator, also closing up here in positive territory. So again, we did end the week on a positive note. Ideally, a break back above that 200-day simple moving average would be even more constructive. But overall, again, we're ending the week on a positive note. Let's take a look here at the Nasdaq composite, and that was down a little bit less than the S&P. Of note is the fact that it did close above this red 50-day simple moving average. Generally, it has been trading in a more constructive manner over the last 2 weeks. We can see your outside momentum. This is your RSI, never got negative. It remains up here in positive territory, and then likewise with the stochastics. I'm pointing out what's called a follow-through day, which took place earlier this month, and that is a system or a way to identify market bottoms. Now, it's not going to be always a true market bottom in the sense that the markets then go on to new highs. What we've seen with these follow-through days, and it's a methodology that has been developed by William O'Neill, and you can read more about it with Investors Business Daily. But most importantly is the fact that it has a follow-through day, has marked the beginning of the several bear market rallies that we've experienced this year or last year. So coming into this year, that is a good start, certainly. And then we can see with this NASDAQ composite that a nice potential continuation rally. Going to keep an eye out at how this index trades here at this 200-day simple moving average, your next area of upside potential resistance. So from here, let's drill down a little bit further and take a look behind the scenes at the 11 sectors in the S&P 500. I've gone ahead and added an RSI, that's a relative strength indicator, and then we can see these sectors from strength to weakness is how they're sorted. And this view is really quite helpful, not only in helping identify where the current relative outperformance is, but also in identifying sector rotation as you see these sectors progress, either from this weaker lower quartile up to the forefront, or likewise away from strength to weakness. It's a very slow progression and really ideal for that type of factoring if you want to, of course, stay on top of areas as they move in and out of favor. So of note here, up here in the forefront, we can see energy and basic materials up here, both commodity related. This is an area that has been trading quite well since the beginning of this year. Here's XLE, that energy ETF, back above that 50, positive momentum indicators there. It's an area I'm heavier weighted with my MEM Edge reports suggested holdings list. And then also basic materials, and this is all about the move. And as we progress, I'll share with you where, but certainly metals and select ones that, again, in our next segment, I'll share with you that strongest area within that basic materials sector. From here, we can take a look at technology, and this is an area that had been languishing down in this weaker quartile, and I've watched it, and those of you that visit and watch each week, you will know as well that technology has been progressing up here so that it's in the upper half among these 11 sectors by way of strength. This is XLK, that technology ETF. We can see it's just getting up here to that 200-day simple moving average, ideally a move above that because we do have positive momentum taking shape there. Down here on that weaker side is more defensive areas. Healthcare, XLV, XLU is utilities, and then consumer staples, XLP. And this has been the theme since the beginning of this year as well, where last year, toward the end of the year, we did see these defensive areas up here at the forefront. So that's a view from the overview. We can then drill down even further. One last area of note here. Let's take a look at XLI because it was down 3.5% for the week. Pretty dramatic decline here. We can see the breakdown here below each of these moving averages. It did have a bit of a rally this week, but I will share with you where the weakness really was evident within these industrials. Rather surprising, but there it is. So from here, we're going to drill down a little bit further using ETFs that I find to be really very powerful as far as helping you stay on top, even in a more refined way as to where that strength or weakness is. So we talked about basic materials, those metals, and here we are up here in the forefront. Gold, GLD is the ticker symbol. You can see that confirmed uptrend as these gold and this particular ETF continues to progress higher. Newer up here in the forefront, certainly IGV, and this is the software ETF. I talked about technology firming up. This is one of the reasons some of these software stocks that have been really beaten down are beginning to progress. The overall group was up 1.5 for the week, this ETF, relative to the markets that were down. From here, we're going to share with you a bigger view, and you'll see that the software stocks were big outperformers, certainly coming out of this bear market. The decline has been real. A number of names in this group down 50, 80% or more, and they are potentially beginning to reverse. This is a weekly view of that software ETF. From here, let's go ahead and take a look at another technology heavyweight area, certainly when they get going. Semiconductors, SOXX, reversed their downtrend the prior week and did pull back with the markets, but really remained above key support with a nice 3% rally today, so that particular group ended the week flat, but constructive on that chart. Also known within these semiconductors, it's very selective as it relates to which areas are doing well. And I will get into that with my MEM Edge report on Sunday. So from here, let's go ahead and drill down. You want to be aware of those weaker areas. I talked about industrials, and in fact, one of the reasons that the Dow Jones Industrial Average was down almost 3%, so more than 3 times the S&P 500 on that decline. We can see that it is struggling to come back into favor, as it has been from year-end into the beginning of this year, but a little bit weak certainly this week. I mentioned retail sales were weak, subsequently pushing several retail names lower. But here we are with XRT, and you can see that it had that downtrend reversal the prior week and was able to regain a presence above each of these shorter-term moving averages with the momentum in positive territory. XRT is a good representation of retail. However, it is only online retailers, and it is more equal weighted. So there's not 1 or 2 names that you can point to, but I would suggest taking a look at the holdings in XRT and get a sense of those areas that are driving that particular group higher. And then also we want to take a look at the yield on the 10-year. This is very impactful, certainly to growth stocks. Definitely remaining in a downtrend. The yield is standing at about that 3.5% level. So that is good news, certainly for growth stocks. I will be keeping a very close eye on that as it relates to the actual rate for that 10-year and then which direction it may be heading. So that's a view of the broader markets, those sectors, and then some underlying industry groups. I did talk about earnings season, so let's go ahead from here and take a look at one way that you can stay on top. There are certainly many ways, but this is with stockcharts.com, the market movers on the S&P 500, and you can see by looking simply at this list that there are several bank names that are up here that have nice gains, certainly on the day. we can see at least 3 bank names and other financially related. And banks are the first area that report their earnings, so that when you see vibrancy and movement, oftentimes it will be directly related to earnings. And that is the case with SVB Financial, for instance, this gap up, big volume. And you can see, if you were to look at this list on a regular basis, you would see a very similar theme regularly, where those biggest movers to the upside on any given day, many of them have reported earnings. Here's Netflix, gap up 8.5%. They did, of course, release numbers yesterday afternoon, and all about subscribership improving. So from here, another company that came out with strong earnings in the industrial area, actually PPG Chemicals, and you can see that the company gapped up 6% gain on the day. So certainly earnings releases to the positive side are big drivers for these companies heading higher. It's also equally impactful on the negative side, and we need only look at a company such as Charles Schwab came out with weak numbers, and then, as will happen, Wall Street then adds their own spin as it relates to their thoughts on the stock, and SCHW was double downgraded after the release of their report, which pushed the stock down even further. Super high volume here. So again, earnings, big driver, not only of individual stock movement, but oftentimes that will translate into other areas within a given group. Let's take a look at AEHR. This is a company that reported a couple of weeks ago. Big downtrend reversal that shaped up here, and you can see that it has had a nice subsequent rally, but it also has spread out. I showed you that semiconductor index SOXX, and you can see that earnings can, again, impact not only just that stock, but also the group overall. Now, I did mention that there was one other big driver of price action, and I'm also going to share with you some of the names as an example, and that is many or several companies, certainly some well-known and otherwise, are announcing cutbacks and layoffs to employees. And this is being viewed positively by investors. Companies are really pulling back on their capital expenditures and thereby potentially preserving their growth. So let's take a look at a couple of those companies that announced today or over this past week that they are reducing staff, and Microsoft is among them. The stock rallied 3.6% today. However, still trapped, does not look attractive, but more to the point is that concept that if you are reducing staff, it is being viewed positively. This is Alphabet, and it had a much more positive because their staff reduction was larger, certainly than Microsoft. But more to the point is we did see a gap up, very high volume, nice positive momentum. MACD now back up there in positive territory. So on the lookout for a potential continuation rally as we move into earnings. Many of these mega cap names are due to report over the next week or two. Another company that came out with announcing that they are cutting back on employees or laying off employees is COF, that's Capital One Financial, and another name that rallied quite strongly in response. Last up, as an example, Wayfair is also cutting employee base, and you can see this 20% rally that took shape here, super big volume and positive momentum. From here, I'm going to take us over to an intraday chart. Oftentimes, these announcements relating to layoffs are going to be pre-market or after the market. So what we can see is on this intraday, what to be on the lookout potentially, and this is using a 15-minute price chart. So we can see this initial gap up on the news. From there, you want to make sure that that third bar beyond that first one closes above the high of that first price bar. And that statistically, historically, will point to further upside, which we did see with this particular stock, you can see it is now in an overbought position, but of note. And that's what I shared with you on that 15-minute can also be used for these companies that are reporting strong earnings. And that's it for this week. Everyone have a fantastic weekend. I'll look for you again here next Friday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.